4 years ago, a warning was given. A new tax law was passed, complicated, quiet, and brushed off by most people as just another policy. But for millions of retirees across the country, that law is now becoming very real and very expensive. You see, when you're working, taxes hit your paycheck. But in retirement, they hit your future, your savings, your peace of mind. This older couple didn't see it coming. They had worked hard, saved smart, and finally thought they could breathe. No more long shifts, no more deadlines, just rest, travel, and family time. But then the letter arrived. Their taxes had gone up, not because they earned more, but because the rules changed. Suddenly, more of their Social Security was taxable. Their required minimum distributions were pushing them into a higher bracket. Their Medicare premiums going up. And they're not alone. Thousands of retirees are quietly losing money each year, not because of bad investments, but because of a tax code designed to favor the wealthy and punish the unaware. And here's the scariest part. Most retirees won't even realize it until it's too late. They'll just see their money disappearing a little faster, their budgets shrinking, their options narrowing. They'll wonder, what did I do wrong? The truth, they didn't do anything wrong, they just didn't act soon enough. Because this isn't just about numbers on a form, it's about lifestyle, independence, dignity. The new tax law changed the rules of retirement, and waiting another 4 years to react could cost you far more than you think. Right now, time is your most valuable asset. Because when you're retired, you can't just make up losses by working extra hours or picking up overtime. You have to plan smarter, move sooner, and understand the system before it works against you. So, what exactly changed under the new tax law, and why is it hitting retirees the hardest? Let's break it down in simple terms. 1. More of your Social Security is now taxable. Under the current rules, if your income crosses a certain threshold, even by a few $100s, up to 85% of your Social Security benefits could be taxed, and many retirees are crossing that line without even realizing it. Thanks to required minimum distributions, part-time income, or small investment gains. 2. Your RMDs are forcing you into higher tax brackets. At age 73, you're required to start withdrawing money from your traditional retirement accounts, whether you need it or not. These withdrawals are taxed as income. And with the new brackets and fewer deductions, many retirees are being pushed into higher tax tiers without warning. 3. Standard deductions may seem larger, but you're still paying more. Yes, the standard deduction was raised, but many itemized deductions, like state and local taxes, were capped. That means retirees in higher cost states are now losing out. 4. Medicare premiums are quietly increasing, because your Medicare premiums are tied to your income. The more you accidentally earn due to RMDs or investments, the more you pay. Some retirees are paying hundreds more per month, just because they didn't plan around these tax triggers. 5. Estate tax thresholds could shift in the next few years if nothing changes. The current estate tax exemptions will drop in 2026. That could impact what you leave behind, especially if your assets are tied up in real estate or retirement accounts. These changes may seem small, but they add up fast, and for someone on a fixed income, even an extra $200 or $300 in taxes or premiums each month can destroy a carefully planned retirement. Most retirees think they have time. They tell themselves, I'll deal with it next year. But under the new tax law, waiting is the most expensive mistake you can make. Because every year you delay adapting your retirement strategy, you're silently losing money, not from bad spending or inflation, but from taxes, penalties, and missed opportunities. Let me break it down. Required minimum distributions (RMDs) grow every year, and the larger your balance, the larger the tax hit. That means the longer you wait to convert money into a Roth IRA or reposition your assets, the more taxes you'll pay later. Medicare premiums don't just go up with inflation, they increase based on your income. So a few extra $1,000 from an RMD or capital gain could put you in a higher bracket, costing you $100 or more every single month. Social Security taxation is a slow trap. It creeps up on you, and suddenly, what used to be a reliable source of income is now partially eaten up by taxes. Because you didn't adjust early enough. And here's the worst part. Most of this is avoidable, but only if you act before the problem hits. Tax planning is proactive, not reactive. If you wait until tax season to think about taxes, it's already too late. And yet, year after year, retirees leave thousands on the table simply because they didn't sit down, run the numbers, or speak with a professional. Time in retirement is not just precious, it's expensive. While most retirees are struggling to keep up with the new tax rules, the wealthy, they're already several steps ahead. They're not reacting, they're planning precisely, legally, and strategically. So, how exactly are they protecting their wealth? 1. Roth conversions. They're moving money from traditional IRAs into Roth IRAs now, while tax rates are relatively low, to avoid bigger tax hits later. Yes, they pay some taxes up front, but they buy decades of tax-free growth in return. 2. Strategic drawdowns. The wealthy aren't waiting for RMDs to force them into higher brackets. They start withdrawing smaller amounts earlier, often in their 60s, to spread the tax burden over time and stay in control of their income. 3. Tax efficiency in investing. They're using municipal bonds, ETFs, and long-term strategies to minimize capital gains taxes. Every investment decision is made with one question in mind: how will this affect my taxes? 4. Trusts and estate planning. Many are moving assets into trusts now, before estate tax exemptions potentially drop in 2026. They're not just thinking about this year, they're planning for the next generation. 5. Professional guidance. They're working with tax advisors, estate planners, and retirement specialists, because they know one wrong move could cost tens of thousands, and one smart decision could save even more. But here's the truth: you don't need millions to use these strategies. You just need awareness, a plan, and the willingness to act before it's too late, because tax laws may favor the wealthy, but they're available to everyone who understands how to use them. The next 4 years will define the next 20. Why? Because we're in a narrow window of opportunity, and most retirees don't even realize it. Right now, tax rates are historically low, but that won't last. Unless Congress acts, those rates are set to go back up in 2026. That means you have just a few short years to make smart, strategic moves before the window closes. This isn't political. It's mathematical, and it's personal, especially if you're near or already in retirement. The decisions you make between now and 2026 will determine how much tax you pay on your retirement savings, whether your Social Security gets heavily taxed, how much you'll owe in Medicare premiums, and what legacy you're able to leave behind. Too many people are sleepwalking through this moment, assuming they'll deal with it later. But later is when the rules change, when your options shrink, when your savings bleed from silent taxes you didn't plan for. You don't need to overhaul your life, but you do need to take action. Meet with a tax advisor, consider Roth conversions, review your RMD strategy, check how Medicare and income interact, plan your estate before the laws change again, because waiting just one more year or even one more month could cost you thousands.